August 24th was a market event where there had been some negative news over the weekend, mostly about China, about events in China. And the markets, as they opened in this country, opened the Dow down about 1,000 points and caused a lot of consternation and a lot of trading and so on. High-frequency traders were involved in that market, buying and selling and trying to facilitate trades. We caught a lot of falling knives during that time, as you might imagine. But again, in the markets, providing liquidity and saving investors money. That was the role of high-frequency traders. Another thing that's come out of that is that ETFs, exchange-traded funds, also traded in ways that people hadn't necessarily seen before, where they deviated from their net asset values by what people thought were large percentages, and people were surprised by that. Since high-frequency traders are among the primary market makers for exchange-traded funds, we saw a lot of interesting things that happened there during that time period, and we also had some ideas about how to improve liquidity in exchange-traded funds. So we wrote a letter to the SEC, and it's gotten quite a bit of attention. We suggested 3 different improvements for how to make exchange-traded fund trading better for investors. So the first one was that we recommend that rules for short selling be eased when you're doing it in conjunction with buying or selling an ETF. We recommended that exchanges clarify their rules for when they will break a trade or bust a trade. And then finally, we recommended something very unique, let's call it a retail circuit breaker. So we feel that brokers or exchanges should offer retail investors the opportunity to pause their ETF order if the net asset value of the ETF deviates from the trading price by a certain set percentage. This is a unique proposal, and we're hoping that we get a lot of uptake on that.